Welcome back to Charged Alpha, the S&P 500 stock encyclopedia. I'm Hudson Thomas, and today we are digging into the company that basically invented the online travel economy, Booking Holdings, ticker BKNG.
This one has an interesting setup, Hudson. In November 2025, the company completed a 20-for-1 stock split. A stock that used to trade north of $3,000 now trades in the low hundreds. The business itself is the same, but the retail accessibility and the options liquidity have completely transformed.
And the business is actually quite healthy underneath. Full year 2025 revenue up 13.4% to nearly $27 billion. Record free cash flow of $9 billion, a $20 billion buyback authorization announced in February.
But the stock is down 24% from the highs. Next earnings is April 28th. So today we are going to unpack whether this is a durable compounder on sale or an AI-disrupted business in slow decline.
Let's do it. Episode 128, Booking Holdings. Let's lay out what Booking Holdings actually is, because most people only know Booking.com. The parent company owns 6 consumer brands. Booking.com is the flagship accommodations, flights, cars, and experiences across more than 220 countries.
Priceline handles both opaque and transparent bookings in North America. Agoda is the Asia-Pacific accommodation specialist, Kayak is the meta-search layer across flights, hotels, and cars, OpenTable handles restaurant reservations, and RentalCars.com is the car rental aggregator.
The core brand is Booking.com, which is responsible for the vast majority of gross travel bookings and revenue. The platform connects around 3.4 million properties with travelers globally, and the scale of that network is the single biggest reason this business has compounded for 2 decades.
There are 2 monetization models. The agency model, where Booking takes a commission when a customer books a hotel, and the merchant model, where Booking facilitates the full transaction, processes payment, and captures higher transaction economics. The merchant model has been growing faster and is a central theme in where management is taking this business.
On top of that, there is what the company calls the connected trip, bundling flights, cars, accommodations, experiences, and payments into a single itinerary. That is the next leg of the growth story, and it is also the defense against AI disintermediation.
Scale matters here. Booking spent over $7 billion on marketing in 2025. That is the largest marketing budget in online travel, and it reinforces brand recognition and direct traffic share in a way no smaller competitor can replicate.
And then on the financial side, $27 billion of revenue, $9 billion of free cash flow, and about 24,500 employees worldwide. That is a very lean operating model for a business this size.
It is also a business that has executed a massive share buyback program for over a decade. Booking has repurchased tens of billions of dollars of its own stock, which is the reason the balance sheet shows negative shareholders' equity, a technical artifact of buybacks, not financial distress.
Let's talk about Glenn Fogel. He has been CEO of Booking Holdings since January 2017, 9 years at the top. Before that, he had been with the company since 2000, initially as head of worldwide strategy and then running corporate development. He is the architect of most of Booking's major acquisitions.
Fogel's reputation on the street is that of a methodical operator. He is not flashy. He does not chase big consumer marketing stunts. His focus has been on quietly building the connected trip vision and redeploying cash into buybacks.
His tenure has coincided with the pandemic disruption, the travel rebound, and now the AI competitive threat. His defining call has been doubling down on the merchant model and payments, rather than diversifying away from travel.
That is a consistent strategy rather than a growth by acquisition playbook. Booking has been disciplined about its M&A in Fogel's era. The focus has been organic platform investment, AI capabilities, and capital return. The street generally views him as a shareholder-friendly operator with strong governance.
Lana, let's get into the numbers.
Valuation first. Booking trades at 26.6 times trailing earnings, 22.4 forward. Price to sales is 5.2. EV to EBITDA is 15.5. PEG is 1.8.
So the forward multiple is reasonable for a consumer internet leader. Not a value stock, not a growth stock, somewhere in between.
Correct. Price to book is not meaningful because the company has negative shareholders' equity from years of aggressive buybacks. That is a technical artifact, not a concern. What matters is that the company produces $9 billion of annual free cash flow against a $140 billion market cap, about a 6.5% FCF yield. Revenue growth. FY 2025 revenue was $26.9 billion, up 13.4% year over year. That is actually an acceleration from 11% in FY 2024.
Which pushes back on the narrative that this is a decelerating story.
The top line is growing faster than it did a year ago. The pushback is that quarterly growth is lumpy because of seasonality. Third quarter is massive, first quarter is small, and year-over-year comparisons are going to tighten as the travel recovery fully normalizes. Margins. Gross margin looks like 100% because FMP does not separate cost of services from revenue for this company. Effectively, there is no cost of goods sold in the traditional sense. Operating margin is 34.5%. Net margin is 20%. Those are excellent consumer internet margins.
And cash flow.
Record $9.09 billion of free cash flow in 2025, up from $7.89 in 2024. Cash conversion is running above 160% of net income thanks to deferred revenue benefits. The company collects from travelers before it pays hotel partners. Sheet. Total debt is $19 billion. Cash and investments are $17.8 billion. Net debt is $1.5 billion, essentially nothing relative to the scale of the business. Debt to EBITDA is 1.9 times. Current ratio is 1.33.
So the balance sheet is fine, the cash flow is strong, the growth is accelerating. What is the market worried about?
Overall, Booking Holdings' financial health is solid. The cash flow profile is excellent. The capital return program is aggressive and revenue is accelerating. The multiple compression reflects AI disintermediation fears and questions about sustainable room night growth as Europe softens.
What is the street saying?
71 analysts cover the name. Consensus is a buy, 46 buys, 25 holds, 0 sells. Consensus price target is $238, implying about 34% upside from the current 177 level.
Notable calls.
Morgan Stanley's Brian Nowak is overweight at 260. Goldman's Eric Sheridan has a buy with a 245 target. Bank of America's Justin Post is buy at 270. JP Morgan's Doug Anmuth is overweight at 255. Wells Fargo's Ken Gorelski is overweight at 275.
So the bulls are clustered in the 240s through 270s range. And no sell ratings at all?
0. That is notable. A broad buy-side consensus with no sell ratings is unusual in large-cap tech right now.
Recent earnings.
Q4 FY 2025 printed an inline EPS at $1.95. Revenue came in at $6.35 billion versus $6.14 expected, so a revenue beat of about 3.5%.
Guidance.
Q1 2026 gross bookings growth targeted at 5 to 7% year over year with room night growth of 4 to 6%. Full year 2026 guidance is 8 to 11% constant currency revenue growth and roughly inline adjusted EBITDA growth.
Next earnings is April 28th. Let me take the bull side. Bull case 1. The connected trip strategy is actually differentiated. Booking is the only online travel player with the scale to bundle flights, hotels, cars, and payments into a single platform at this scale. That creates defense against AI-only travel agents. Bull case 2. The $20 billion buyback program announced in February is roughly 14% of the market cap. That is more than 2 full years of projected free cash flow earmarked for share reduction. The EPS accretion math through 2027 is significant. Bull case 3. Revenue growth is accelerating, not decelerating. 13.4% in 2025 versus 11% in 2024. That is the opposite of the decelerating narrative the stock price implies.
Now the bear case. Bear case 1. AI disintermediation is the elephant in the room. Google's AI overviews, ChatGPT's travel agents, and Microsoft's Copilot are all rolling out native travel planning tools. If travelers start planning trips inside those interfaces and only transacting at the end, bookings funnel compresses dramatically. Bear case 2. European consumer softness. Roughly half of gross bookings come from European travelers. A continued slowdown in discretionary spending, elevated energy costs, or geopolitical disruption would pressure room night growth and potentially force marketing spend higher just to maintain share. Bear case 3. Hotel supply is consolidating its direct booking pressure. Major chains like Marriott, Hilton, and Hyatt are investing heavily in loyalty programs and direct booking incentives, specifically to reduce OTA commissions. Over time, that squeezes the take rate.
How does Booking stack up against its peers?
4 relevant comparisons: Expedia at 14.5 times earnings, 7% revenue growth, 15% margin. Airbnb at 35.8 times, 11.5% growth, 24% margin. TripAdvisor at 21 times, 3.8% growth, 9.5% margin. Marriott at 24.3 times, 6.7% growth, 13% margin.
So Booking has higher revenue growth than Expedia, TripAdvisor, and Marriott, and better margins than all of them except Airbnb.
Correct. The multiple is elevated versus Expedia and Marriott, but roughly in line with Airbnb at a lower peg, given the faster growth. The comparison that matters most is Airbnb. Similar growth profile, similar technology stack narrative, and Booking trades at a lower multiple, despite more diverse revenue streams.
Options activity.
Volume is running about 1.6 times the 30-day average ahead of April 28th earnings. Put-to-call ratio is 0.92, near the historical median. Implied volatility is at the 65th percentile.
Expected move?
The at-the-money straddle is pricing a 5.5% move on earnings. That is slightly above the historical median of 4%. Open interest clusters at the 180 and 190 call strikes suggest hedging from underweight positions. The largest put strike is 170, which is downside protection by long holders.
So the options market is not pricing a binary event, just a typical earnings move.
And the positioning does not look euphoric or panicked. It looks balanced, which is unusual given how loud the AI disintermediation debate has become.
Insider activity.
Net insider selling of approximately $68 million over the past 90 days, predominantly scheduled 10b5-1 plan sales from CEO Fogel and CFO Ewout Steenbergen. No material open market purchases by any officer or director.
Separately, the $20 billion buyback authorization from February is the more meaningful capital signal.
Booking repurchased approximately $6 billion of stock in 2025. The corporate repurchase cadence provides an implicit floor on float and creates mechanical EPS accretion even without revenue acceleration.
Let's walk through the risks.
Top risk is AI-driven disintermediation. Google's AI overviews and large language model travel agents could compress the search funnel. Booking has dominated.
Risk 2. European consumer softness. Half of gross bookings are European, and that base is price sensitive.
Risk 3. Marketing leverage has peaked. Booking spent over $7 billion on marketing in 2025, and further efficiency gains look limited.
Risk 4. Regulatory. The EU Digital Markets Act, digital services taxes, and short-term rental compliance rules create ongoing margin and litigation exposure.
Risk 5. Hotel supply concentration. Major chains are aggressively pushing direct booking, which over time compresses bookings' take rate.
Key metrics to watch: constant currency room night growth, marketing expense as a percentage of gross bookings, and merchant model adoption. Those 3 numbers tell you whether the engine is still running.
Forward catalysts, April 28th earnings, the connected trip product updates at the next partner conference, and continued buyback cadence.
Bottom line, Booking Holdings' financial health is solid. $9 billion in free cash flow, accelerating revenue growth, a $20 billion buyback authorization, and a post-split share price that invites retail participation.
The market is pricing AI disintermediation that has not yet shown up in the numbers. The next 3 earnings prints will tell us whether the platform is defending its funnel or losing share.
The single most important data point to watch this year is marketing expense as a percentage of revenue. If that ratio creeps up even while growth holds, the bears will be proven right. If it stays stable or declines as revenue grows, the defensive moat is holding.
Watch the April 28th print carefully.
Closing quote from CEO Glenn Fogel on the Q4 2025 earnings call. Quote, "We are building the connected trip, the one place where every element of travel, from accommodations to flights to experiences to payments, is planned, booked, and paid for in a single itinerary. That is the future, and we are the only player at the scale it requires." End quote.
Strong framing. The market will decide whether the scale is enough to defend.
That's going to do it for episode 128 of Charged Alpha. Booking Holdings, ticker BKNG. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.